Are you seriously feeling overwhelmed with opening up your trading accounts, trying to figure out this whole pattern day trading rule stuff? Not only that, you've probably wondered about your retirement accounts. How do I trade in them? How do I invest in them? And that kind of stuff, right? Well, you're probably also struggling with how do you buy the stock? How do you sell the stock? What's this whole short selling stuff all about, right? And more importantly, what about volatility? How does it affect the market? How does it affect your trading? What about stock halts when you're trading small caps? What about the float and how does it affect the volatility for really big trades? What we're going to do is we're going to talk about the accounts that you're going to be needing to set up, and as well as go over all the rules in the pattern day trading stuff. We're going to talk about retirement accounts and all of this stuff that we're going to be needing for that. We're also going to be talking about short selling. We're going to be talking about all the things you're going to need to know about volatility and float and how it affects small cap and large cap trading. And by the end of this video, you're going to feel very confident and very assured that you know the things that are necessary moving forward as an active stock trader. Hey there traders, Sean Kozak here, tuning in again with Rrsp Trading Academy. And for the world's best trading education and strategies, make sure you hit that subscribe button and don't forget to turn that notification bell on. That's going to keep you notified every time we put out awesome content like this, and it's going to help you get the results you're looking for. Last but not least, smash that like button so that we know you're enjoying the content.
Welcome back, traders. In this video, we're going to be breaking down the Stocks Explained Part 2 lesson, essentially looking at buying and selling stocks as an asset. Now, if you didn't get a chance to watch the first video on the foundation of stock trading, definitely want to check that out because it's a very big video, and we're going to pick up where we left off so that you guys can build a strong foundation moving forward. As always, if you have any questions on the material or if you need assistance, we're just an email away. So when we start trading, we need to understand that there's different types of accounts that we can open up with our broker. So there's cash accounts, margin accounts, and retirement accounts. Okay, when you open up an account, you're going to be asked to sign an agreement. This is to declare yourself as a non-professional, and basically, in the eyes of the regulators, professional means you're a licensed trader, and if you're not a licensed professional, then you're considered retail non-pro. And the reason this is important is because of the data fees and the cost of the exchange. If you're a professional and you're trading under a license and you're actually considered a professional trader, then you'll have a lot more expenses and a lot higher fees for data and also for platforms and brokerages and stuff like that, because they classify you as more of a professional in the space. And so it's always good to just make sure that when you're opening up an account, as long as you're not licensed, you can say that you're a non-professional. That doesn't mean you're not a good trader. It just means non-professional in terms of licenses and regulations. Now, the cash accounts are basically cash, one-to-one valuation. Margin accounts will give you margin and leverage. And pattern day trading rules in trading with as little as $500. So you can actually, depending on the types of accounts you open, you'll be required to meet the pattern day trading rules requirements. And depending on if you're using a non-PDT broker, sometimes you can fund as an account with as little as $500 and then onwards to the upside. Now, retirement accounts, these are different because retirement accounts are actually registered access accounts. Depending on their country of origin, if you're in the United States or if you're in Canada or other countries at best, you might have a 401k, an IRA, a Roth IRA, or an Rrsp, a LIRA, a tax-free savings account, TFSA. So it really just depends on your regulations, and your industry, or excuse me, your country that you live in will determine the types of retirement accounts. Now, these are Canadian and United States accounts because we're a Canadian organization, but if you're in the European Union or if you're in other countries, definitely check with your brokerage accounts. Okay, so let's go over them in and of itself. A cash account is an account with a brokerage firm that will allow you to trade from. However, you must wait 2 days for each trade to settle before you can take another trade. And that's called the settlement period. You cannot short stocks in a cash account, and you're subject to free riding rules. Active day traders don't really use cash accounts. It requires their capital daily for active trading. If you're going to be a day trader, you're not doing a cash account because ultimately you're not able to get in and out on a regular basis over and over again, and you're limited because you can't buy on margin. Now, the main account is margin accounts, and basically you can have unlimited number of trades per day, up to 4 times leverage buying power. You must maintain the correct balance and margin requirements with the broker, and they don't have a settlement period. You will be subject to interest charges on stocks held overnight using margin. You are subject to the PDTR. PDTR is the acronym for Pattern Day Trading Rule. We'll be going over that in more detail. You can buy and sell stocks actively as long as there are stocks to short on the brokerage list. And normally what that means is some brokers have a short list, and then obviously you can always buy stocks, but a short list is always there to have access to shorting stocks. And some brokers have bigger short lists than others, but you can do both in a margin account. And these are the main accounts for active day traders. Okay, so if you're going to be trading stocks on an active account, you're going to definitely want a margin account. So when we talk about leverage and buying power, all margin accounts except registered retirement accounts offer 4 times leverage and buying power. An example would be if you have a $25,000 account deposit with 4 times leverage, you actually have access to $100,000 in buying power. Okay, so if you trade 100,000 K leverage on an account with a $25,000 balance and you gain 10%, that's $10,000, which is close to 50% gain on your account, right? It's a huge win. However, leverage works both ways. So if you lose 10% on the 100K, you nearly blow out your entire account. So this is something you need to understand very, very actively. You never want to over leverage your accounts, especially trading on margin. And it's very good to use risk and money management wisely. We have a section in our strategies course that breaks down position sizing and risk metrics for all trading strategies. You'll definitely want to check that out once you join our more active trading programs and join our education and strategies courses. Okay, so essentially, small cash investments can produce large amounts of profit, but also small cash investments can also produce large amounts of loss. So in summary, when used correctly, margin is very powerful, but used incorrectly can be devastating, right? So just make sure you treat it with humility and you understand what the difference is. So when you get a margin call, hopefully you never get one. I've never had one, and I don't really know too many people that have, especially not in our organization or our student line, because ultimately we teach traders to never trade outside of their risk requirements. And most importantly, a margin call is when you breach the rules of your margin levels, right? So normally if this happens, you either A, are trading well outside of your risk profile, or B, maybe you just had a technical problem. Sometimes a margin call can happen if you have a technical outage, you lose internet, something happens with your computer, power goes out, and you didn't have a stop loss in, and something happens in the market. It can happen. So you always want to make sure you're trading with a stop loss. You always want to make sure that you understand your margin requirements at the broker level, and just know that if you do not meet their requirements, they can trigger a margin call. They'll normally try to contact you first, but they do have the power to liquidate your position. And you definitely want to make sure that you respect the margin requirements. So if you have any questions on margin calls, you definitely want to check with your broker, because depending on which broker you're using, will definitely have different margin requirements. So let's talk about something that's very, very important in the stock trading industry. It's often misunderstood, so you just want to make sure that you understand it. The pattern day trading rule is for the stock market, okay? And it was put in place by regulatory agencies and the regulators in the industry to encourage, if you're going to trade as a pattern day trader, you definitely want to have enough capital to do so. And there's a lot of reasons why the stock market is really favored to the long side. The stock market wants to favor buying activity more than selling, and they definitely want to make sure that if you are going to be a day trader, that you're actively equipped to do so. The PDTR states that if you day trade more than 3 times in a 5-day period, you need to maintain a minimum balance of $25,000 in cash or stock, so you can have a position to keep your margin account in standing order. There are several offshore brokers that will allow you to trade on margin with as little as $500. But if you're under the 25K limit for PDT, for the pattern day trading rule, and don't want to open offshore accounts, then you must adhere to the rules. So essentially, a day trade only 3 round trips per week. So if you're not following the PDTR, if you don't have $25,000, okay, and that means, basically what happens is you can only day trade 3 round trips per week using margin and buying power until the account is above 25 grand. You can swing trade, hold stocks for longer periods of time. You can trade options that settle overnight, and you can also offer higher leverage and percentage returns, but they can only be traded on large cap stocks. So let me kind of explain this in simple terms. Let's kind of break this down. Round trip means, let me give you an example, and I'll explain how this works. So let's say you buy 1,000 shares of a stock, and then you sell 1,000 shares. That is considered one round trip trade. Let's consider you buy another 500 shares and then you sell the 500 shares. That's one round trip trade. Let's say you buy another 5,000 shares, then you sell 1,000 shares, you buy 500 shares, then you sell 400 shares. That equals 2 round trip trades, right? When you change directions, you are beginning another round trip of a trade. Okay, if you buy a 500 shares and buy another 500 shares, this is half trip. So if you're legging into a position, you're adding to a position, right? It is not considered a full round trip. So it's really important to understand that, because pattern day trading rules states that you can only have 3 round trip trades in a 5-day period with $25,000 or less. Otherwise, you get flagged for PDT, and then you could basically be audited in your account, and it can trigger just a whole lot of tax implications and just a bunch of headaches. So you just really want to make sure that you understand what this means. And it's required. Like, in order for you to be on margin, the brokers are going to require this, right? You can't be breaching those rules or regulations set by the industry, because it is an industry required rule, right? And it's at a broker level. So when you look at cash versus margin, when you're under that $25,000 balance, let's say you have a $3,000 cash account, it'll let you trade $1,500 every day, which is $7,500 per week, okay? A $3,000 margin account will let you trade $9,000 every 5 days, or 3 trades in 1 day. Okay, so you just got to understand you're limited, okay, based off of the amount of trades you can take. And you'll have more leverage, and cash is used in a margin account. However, cash accounts lets you trade more, depending on what you prefer. Both have pros and cons. When trading with a small account, often it's less pressure to trade a cash account at first, so you're not sabotaging your trading under the pressure of the PDTR. And once you have enough money, you can move to a margin account and trade with. Simply put, my suggestion, okay, and this is truly a strong suggestion, if you're watching this video and you're not equipped with $25,000 in capital, then you should look to maybe day trade either a small account in a non-PDT broker if you can. If not, then I would highly encourage you to check out some of our other programs on futures and Forex, because those will equip you to be able to trade smaller accounts without the PDT rules. You will not be able to participate in the stock courses because you wouldn't have enough capital. And normally, this is normally what we normally tell traders in our school, is that you want to know the pros and cons. I'm not saying you can't trade a small account with stocks. I'm just saying you put more restrictions on yourself. So normally we tell traders, if you're going to be day trading the stock market, you want to have a minimum of $25,000 in your account. Okay, if not, then you'll have to be following these rules, which puts limitations on how many trades you can take per week, etc., based on your cash or margin account. Okay, and it's just the pros and cons of the industry. Just knowing what you can and cannot do is really important. Okay, so rule number 1, try to have $25,000 in your account if you can. Rule number 2, if you don't, check out the futures and Forex programs, right? Or look at using a non-PDT broker. Now, if we look at retirement accounts, this may or may not apply to you, depending on if you're watching this and you have retirement accounts, or if you don't have retirement accounts. This is going to be based on United States and Canadian information, because we're a Canadian organization, and we, majority of our trading clients at the time of this video is in the US and Canada, and some internationally, but we, I think it's best that we cater to this first because we have more information to provide on it. If you are in Europe or Asia or Australia or other countries, definitely want to check with your banks and your financial advisors or anybody that you work with for retirement funding. Okay, so essentially, many countries have government-sponsored programs. So this is a little bit different than the day trading accounts, because government-sponsored programs are retirement accounts, tax planning. They're meant for tax havens. In the United States, they have 401ks and IRAs. In Canada, they have Rrsps and LIRAs, as well as tax-free savings accounts, TFSAs. They all have tax advantages, and they're meant for investment vehicles and tax purposes. Some of them are tax-free, some are tax-deferred, some can be used for day trading, some can only be used for investing. Some you can go buy long and short in markets, and some you can only buy the market. So depending on the account you're using will determine what you can legally trade it, like how you can trade it. And depending on the country of residency will determine, the retirement accounts you have access to. So just a disclaimer here, it's very important here to understand that it's important to speak to a professional tax accountant prior to trading in your retirement accounts. There may be tax implications. We will discuss in more detail, but we're not legally allowed to give you investment or tax advice. We are not qualified to do so. I am not qualified to do so. I know a lot about it. I can guide you in terms of the education, but we're still not qualified to, encourage you to listen to us as an advisor, so to speak, right? So just a legal disclaimer here as we talk about retirement accounts. So let's talk about the 401k. 401k is an employer-sponsored retirement account. It can be managed or self-directed and is transferred from your employer, 401k provider upon leaving the job. There's a limit per year that can be contributed to, but the amount is subject to increase over time. Funds from a 401k can be withdrawn from your company plan and converted to an IRA when you switch employers or jobs. This is a USA account. The gains are tax-free except when profits are withdrawn. Okay. Now, the other main account, okay, is an IRA. Now, the IRA is a little bit more moving parts than the 401k, and the difference between the IRA, which is traditional IRA, or the Roth IRA has to do with how the taxes are dealt with. Okay, so let me explain this. There's an individual retirement account, which is what the IRA is. That's what they call it. And there's two types of IRAs. There's a traditional IRA and a Roth IRA. Okay, traditional IRAs, okay, gains are tax-free except when the profits are taken out. Contributions are made pre-tax dollars before income taxes are taken out. Max contribution limits will apply, so you can only contribute so much at a certain period of time, ongoing. And you can day trade in this account, and you can actually convert a traditional IRA to a Roth IRA. Okay, so that's important to know that. It's very important to know that. A Roth IRA, gains are tax-free, both as you grow the account and you withdraw the funds. This makes this account very appealing to the active traders. Okay, so contributions are made post-tax after income taxes have been deducted. There are max contribution limits, and there is an income limit to make direct contributions to a Roth IRA. However, there is no limits on doing a traditional IRA to a Roth IRA conversion. So a lot of traders don't know this, but you can actually convert your traditional IRA to a Roth. And what this means is that if you make over $200,000 annually, you can't get both. You can't get a Roth IRA. However, you can get a traditional IRA and then pay tax on that money and convert it over. So I really encourage you to speak to a tax professional on this, because there's advantages to using the Roth IRA if you're able to transfer that over. Now, both of them have max contribution room limits that can change year to year with age. Both are USA accounts. You cannot short stocks or trade on margin, and you can't take profits until you're 59 and a half years old. But they do have incentives. So if you want to build an SDAG and trade that as well as day trade your accounts, there's nothing wrong with day trading and then also bridging and trading a retirement account, right? It's up to you. So let's shift gears now and talk about Canadian accounts. There's a registered retirement savings plan, okay, Rrsp. It is a retirement plan, and it's used for employees and self-employed people in Canada. Its pre-tax money is placed into an Rrsp, and it grows tax-free until you take it out, at which time it is taxed at the marginal tax rate. Okay, contributions are made pre-tax before income taxes have been deducted, and max contribution limits apply. Okay, one of the things you want to know about an Rrsp is it was designed as a retirement savings vehicle that offers tax advantages. It does, however, have gray areas when relating this account to day trading and tax responsibilities. You can't just day trade in your Rrsp without potentially triggering an audit or taxes. Canada Revenue Agency, the government, uses 4 main criteria to determine if you should be awarded an Rrsp tax advantage or be taxed as business income. So it's very important that you do not breach this, because if you don't understand this, you could flag red flags at the regulatory side, and you can be caught yourself in a situation. So how the criteria that the CRA uses for Rrsp trading for trading is they're going to look at how often are you trading, how long are you holding those positions, how much time you spend trading on market research, and how substantial is your trading income. And when you start going into those questions, if you're really actively trading, you're going to breach those rules, right? So you can use so the question is, so can you use an Rrsp for day trading, right? In short, the answer is no. Okay, if your trading activity is considered business income according to these 4 definitions above, tax-free savings account is meant for long-term savings and investing, and some casual swing trading with options or stocks is allowed in a TFSA as well, and an Rrsp. Okay, so this is working for both Rrsps and TFSAs. There's a little bit of a typo there. So we also have that on the next slide. Okay, so if we talk about the tax-free savings account, okay, a tax-free savings account is just a different type of account, and it's a registered investment or savings account that allows for tax-free gains. So this is really an appealing account because people think that they can take a tax-free savings account, trade it, and then they never have to pay tax on the gain. So that was the misconception at the beginning when these accounts were created, and the government put a stop to that, right? So the amount of money that can be contributed to if a TFSA is limited each year, and a TFSA can be used for any savings goals, and withdrawals can be made free of tax. Contributions are made post-tax after income taxes have been deducted. So if you realize this type of account is used post-tax money. And so that's why the taxes, that's why the gains on the account is tax-free, because you've already paid tax on the money that you've put in on that account. So it's important to understand that it was designed as a tax-free haven. It does, however, have gray areas, just like an RSP. You can't just day trade in these TFSAs. They have the same criteria for the RSP as they do for the TFSA. So the main question is can you use it for day trading? And the answer is no. If you want to swing trade or invest in the market, yes, but not for active day trading. Okay. And the reason for this is that it's just they're going to look at this as business income, and they're not going to tax you as an investment safe haven for taxes. Okay. So if you're Canadian, or if you're United States or Canadian, just know the differences between the accounts. And I truly encourage you to check with the tax professional so that you can make sure you get the legal representation that you need. Okay, so let's talk a little bit about bull and bear markets and retirement accounts. One of the things that I really want to give you information on is inverse accounts. And so one of the biggest questions we always get, and we just had this, I traded, I've been around for a while. I was around when I first got started through the 2008 market crash with the United States, real estate market tumbled. We had credit default swaps. All the stuff was going on in the United States, and it was just a nightmare in the market. And then now we just had COVID-19 that just hit with the pandemic. At the time of filming this video, we just got through that this year, and so what happens is the entire market drops and it tanks, and everybody loses their shirt. And so everybody's looking for ways to protect their accounts. Everyone's looking for ways to make money where that losses are happening. And normally a lot of traders lose opportunity costs because their money's tied up in a bear market and they're giving away everything that they've gained over the years, right? So the thing here is that you can't sell short the market. So unlike day trading you can buy the market and sell high, and you can sell the market and buy low. You can short stocks. You can buy long, okay? And you can sell short, okay? Absolutely. And the big thing here is understanding the difference is that you can do this in a day trading account, but you cannot do that in a retirement account. Retirement accounts do not allow for short sells. So short sell stocks are not allowed. And so what happens is that everybody makes money in a bull market, but then when the market's tanking, they give it all back, and they're sitting there like, oh my God, what do I do? Well, what we do is we have a strategy that allows you to hedge your portfolio or hedge your accounts. And what this means is we use inverse ETFs. So what happens when the main stock markets are dropping, the inverse is a market that tracks this completely opposite. So these are designed as alternative safe havens for active traders and investors to buy this market as an inverse, so that even though your retirement account could be dropping, you could either close positions and go to cash and then wait it out, or what you can do is you can either hold the long positions as the market's dropping, and you could also buy the inverse markets as they're going up, so that you're actually hedging your risk, so that you have a zero-sum game. You're not losing, but you're not really gaining. Or what you do is when the markets are dropping, as soon as you have the cue to do so, we have normal technical reasons to stop trading long and just exit the position, and then we would just buy that. So what ends up happening is you're not taking losses on the way down, but you're capitalizing on trading long inverse ETFs, so you actually get to double dip and make money in your retirement accounts. So it's a very appealing strategy for traders. Okay, and it's very appealing to everyone here that is using retirement accounts. So make sure you understand that we have programs for this. I'm going to show you an example of this right now. So an example of this would be, we have an inverse hedge workspace here, and we don't really look at a lot of markets for this because it's not really relevant. I'll give you an example here. This is the spiders. This is the S&P 500. So this is essentially, the S&P 500 index, and you can see here that we had. The market crashed here. Okay, the market, let me go over here. You can see that this is 2020 right here, September, October, November, and that's an hourly chart. Let me go to a daily chart so we can see this. So this is the pandemic that happened on the COVID pandemic. Okay, so I remember traders calling me and saying, Sean, what do I do? I'm losing all of my money that I've gained since the entire year, and that's the problem. It's stair step up, elevator down. Stair step up, elevator down. So what ends up happening is it's not so much the losses that everybody panics. It's that your money was tied up with opportunity costs, and you sat there and you had to wait an entire year to give it back in 5 days. And that happens all the time. Most inexperienced traders don't realize this, that take a look at how fast the drops happen. Look how long it takes the market to go up, but look how long it takes the market to drop, giving back 50% of your gains. This gave back 100% of that rally. So you waited an entire year to give it all back in a year, in 5 days, which it's not even about why it happened. It's when it's happening, what do we do? And so in situations like this, if I go back and take a look, if we go and we take a look at the time that happened, okay, just look at the date. Just look at the date here and look at the date here. As soon as the stock market tanked, this market ripped to the upside. So what you do is we have strategies that we're going to teach you how to close your positions when the rules break. You'll take a little bit of a loss here, but you're going to make it back and then grow so much more here on the upside because you can buy this market long. And it's much more affordable because it's an affordable inverse ETF. And there's only 4 of them we look at. You can trade the Nasdaq inverse, or the spiders, the Dow Jones, and that. But really, it's there as a hedge, but it's also there as a double dip. So we're going to teach you that when we get into the actual strategies courses that we have built in the School for the Live classrooms. Okay. So let's talk about the anatomy of a trade. Keeping it basic. This is an intro course, so we're just going to keep it super simple. Okay. When you buy stocks, you buy the market low, okay? You buy the market low and you sell the market high. That's how you make a profit. You put a stop loss down here. A stop loss protects your account from losing money, and then you take a target up here so you make money on the profit as you buy low and you sell high. That's favored in the stock market and all markets like futures, Forex, all of that stuff. But the key here is understanding the short side. And it's not as shorting stocks is not as favored in the stock market, but it is definitely done as long as your broker has a short list that's favorable and you're experienced. You definitely don't want to be shorting stocks that you don't know what you're doing, okay? So the big thing here is knowing that when you sell the stock, right, basically what's happening is you have to basically borrow the stock from your broker because you don't own the stock. If you didn't have ownership in the company, you didn't own the stock, you're going to borrow the stock. And what's going to happen is you're immediately going to borrow it from your broker. They're going to give it to you, and you're going to initiate a sell position. So you're going to sell stocks in the open market. Someone has to buy those stocks from you. So now you're short the market. And in order to make money, you put a stop loss up here to protect your account. And the only way you make money is when the market goes down. So day trading allows you to profit on the upside and profit to the downside. You can't do this in a retirement account, but you can do this in a day trading account. And so the big thing here is that when this is happening in a retirement account, we would use inverse ETFs and always trade long anyways. But majority of our day trading strategies are over here. We don't spend too much time looking at shorting the stocks. The only time is in key areas, and it's a little bit more advanced, okay? But definitely we will teach you to do both so that you understand the difference, okay? So let's kind of talk a little bit about the different types of market conditions. There's only 3 types of markets. You have a bullish market, you have a neutral market, and you have a downtrending market. And this is super basic because it's intended to be basic. We're not sitting here teaching actionable strategies just yet. I want to make sure that you have a foundation of the lingo. I want to make sure you have a foundation of the jargon and understand what we're talking about. The main thing here is that an uptrending market is normally controlled by buyer sentiment. A sideways market can be both buyers or sellers. A downtrending market is controlled by sellers. And the way we look at trends is not just based off higher highs and higher lows. We actually look at it based off volume and structure and stuff. So we're going to teach you how to read the trends in our pattern lessons. We have an education course that breaks down all of how to read the market and how to understand price and such, and so that you truly get an understanding of how to read the charts, because a chart is a chart, but it's different, right? So if I go here and I look at, say, this chart here, if I'm looking at, Allied Health today, this chart's going to have patterns on it that, we're going to see that we had an uptrend here. And, you can see that we traded up, pullback, big rally, deep pullback, deeper pullback, held the ABC, broke to the upside. But on another stock, right, you could take a look at a different stock completely and look at this one didn't have the same pattern. We just went straight up and then sideways. So the thing here is that not all stocks trade the same. Not all markets are treated the same. And so it's very important to teach you how to read the market, and it's very important to teach you how to understand the different trending conditions. But the market can only ever do these 3 things. You can either go up, sideways, or down, and it can never change. It'll never, ever change. So you only have to worry about learning uptrending markets, range-bound markets, and downtrending markets. Okay? So I want to talk a little bit more on the short selling so that you understand what's happening a little bit. And I know I kind of touched base on this, but I just want to kind of touch base on it again. When you're shorting stocks, you're borrowing it. Okay. And most traders don't understand this at first, because let's say you don't own the shares, right? You're not an owner of the stock. You don't own the company stock. So let's say you want to take position in the short side of the market, right? Like, let's say you want to make money on the market going down. You want to see this trading down like this, and you want to ride the downtrend. Well, that would mean you don't want to be buying the stock, because you would be losing money if you were buying the stock, and you want to participate in a downtrending market. So what do? Well, we always can trade up if we want to trade the market up and make money that way. We could sit on our hands and not trade the downtrend and just wait for the market to rotate back up. Or what we can do is we can short sell the market. And short selling the market means that we profit from a decline in price. We sell high and we buy low, which means we would want to try to short a pullback here and buy it back here to make money. No different than if we were to buy a pullback here and try to sell it here if we were trading the opposing side. So what ends up happening, and it's an automatic process. Like, let's say you have a buy button and you have a sell button, right? As soon as you click the sell button, it triggers this sequence of events, right? It's not something you have to call up, send an email, get on the phone, or negotiate a deal here. This is day trading. This is active, all done electronically on your platform. It's just, you need to understand the process. You're borrowing shares from your broker to sell in the market because you don't own the stock. Even if you don't own the stock as an investor, you would not be shorting the stock you own, right? Like if you own the stock, you don't want to be shorting the stock, because, like, let's say you're holding on to Apple. Let's say you're an investor in Apple stock, and you're an investor from like $100 and it's trading at $800, okay? You're not going to sell those shares, and if you're trying to hold on for a long period of time. But let's say as a day trader, the chart's going down and you want to make money now on an intraday basis on Apple. You're not going to sell all your shares. What you do is you want to open up a new position and sell short those positions, maybe in a different account or such. And what's happening, okay, you're basically going to borrow those shares from the broker, and you're going to sell them in the open market. So as soon as you hit the sell button, the broker lends you the shares, you automatically sell them to a buyer in the market, and then you need to let the market go down in price, and then you buy them back, and they automatically get returned to your broker. You're only responsible for the shares you borrow. You're not responsible for anything else. You borrow, let's say, 100 shares. When you sell them to the open market, you're selling 100 shares to the open market, or whoever's buying it, doesn't matter. And then after you make your money, you've hit a target, you basically take those shares, you close the position, they go back to your broker instantaneously. So all that matters is you understand that you're initiating a short sale position in the market, and that's it. Okay, simple as that. It's keeping it simple. Okay. So key points on shorting stocks is something super important here. You can't short sell in a retirement account, as we've talked about several times. You can't short all stocks. Some brokers charge extra money to borrow and short the stock. You sometimes must reserve the stocks to short and do this pre-market. And realistically, it's a pain in the freaking you-know-what. So you can only short stocks on a regular trading account or self-directed accounts. You cannot use registered accounts. A couple things here. IPOs are rarely shortable since brokers doesn't have the shares available, so you're not going to be shorting an IPO very often. Stocks under $10 are much harder to borrow. This is why we mainly trade small caps to the long side. Super, super important, okay? And that's why if I take a look here, I'll show you, this is my gap scanners down here, and you're going to notice that, these are all small caps, but you don't see any negative numbers in here. Why? Because I'm looking for percentage gappers up. So in our scans, I'm looking for stocks gapping up 10% on the day, and I'm only looking to trade long side. So if I look at all these markets, I'm only looking to go long the market. I'm only looking to buy the market up. These are strong uptrending stocks that our scanners find these stocks, so you only have to worry about buying them. Could you sell? Sure, I could go in here and look for the weakest stocks, but then it becomes more of a hassle. And so it's really about picking and choosing your battles and deciding how difficult you want to making money. You could either keep it super simple and trade easily, or try to do all this extra complicated stuff. And it's really just about, getting started first and then adding on your skill sets after. Okay, so some brokers charge a borrowing fee. This is like an extra commission. So even though you're taking a trade, sometimes you got to pay an extra fee over and above. And You know, short selling is discouraged by institutions. Like, it's actually, they don't want you to be selling stock. The market wants you to be buying stock. It's what the stock market was designed to do, is for people to invest and buy shares in companies. That's the whole purpose. So when you short the stocks, you know, they make so many of these restrictions and loopholes for you to jump through, and it's just one of the reasons why, you know, short selling is kind of frowned upon by the stock market, right? And it's not that you shouldn't short, it's just that you need to understand the pros and cons of both, okay? So a couple things here. I'll continue on the short selling. Days to cover. Brokers will give you a deadline on how long you can actually borrow the shares to short sell. So sometimes if you want to short a stock for more than a day, you want to swing trade it, you got a window of opportunity here, okay? And you just need to make sure you understand that. Or you could be charged a liquidation fee. You could be charged. They could liquidate your stock. You just need to know the difference. A couple things too with a short squeeze. So a short squeeze is when a stock starts to rally and all the traders who are short the stock start buying to cover their positions. So let me give you an example, okay? Let's say you're short the stock and then it starts going sideways. And then what ends up happening is some type of news comes out or something happens and it triggers buyers in the stock. So what ends up happening is all the short sellers are also buying to close, which creates buying activity. And then all the people that are buying on the news are creating a buying activity. And that's what happens when you get these massive 50% gainers on the day. Like, this is exactly why you would see this stock right here. This was a short squeeze. This market is sitting here like this sideways. Boom, 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 boom. All these traders were short from way up here. $5 dropping down, and then you get some news. You can see you squeezed up, and it rips from $4 to $8 in one day. That's a 100% gain on the stock in one day. And that's what a short squeeze is. And so this is why, you know, we're not looking to hold the bag on this. You definitely don't want to be short a stock that's squeezing. It can be very, and it's very good for us to trade the long side. We actually want to be trading the short squeeze stocks, but trading the long scanners, and our scanners will find those for you. Just know that you definitely want to just know that and make sure you understand the difference. Okay, so the biggest risk of shorting stocks is if the short trade goes against you, it can create unlimited loss since you never own the stock you borrowed. This causes traders to blow out their accounts and actually owe the broker money. Most simulators will allow short selling all the time for practice. However, this is not really the real world of trading. You want to be very careful. If you short a stock and something happens and he blows out your account, you're not only lose the money, but you have to pay the broker back. So this is one of the reasons why you got to be really careful with the short sale restrictions, SSRs. So short sale restrictions occur when a stock drops, say 10% versus the prior day, or once the stock once a stock has an SSR, traders can't take a short. Like once this has happened, once there's an SSR restriction on the stock, what ends up happening is a lot of times the stock halts. And there's short sale restrictions, and a lot of times like the stock can't be shorted, and it's just, you can only take trades on the asking price. You got to wait for buyers to buy the shares they're trying to sell, and it's just a nightmare, right? So you want to make sure you're not trading stocks that are triggering short sale restrictions, and this is one of the reasons why we always try to tend to focus on the buying of the market. And if you want to participate on both sides, then maybe look at options or look at futures or forex, right? So a couple things here is there are circuit breaker halts, and one of the things here, a circuit breaker halt or a short sale restriction, are when the regulatory agencies, they put thresholds into the market. So when volatility spikes on either buy sides or sell sides of the market, after it hits a certain threshold, the market stops trading. It's kind of like a breather. It's a cool-off period. So whenever the market kind of flips in one direction, one way or the other, the main thing here is knowing that you have to wait for the stock market to start trading that stock again. And sometimes you can have big price gaps. Sometimes the supply and demand imbalances will be so crazy. Like, let's say you're trading a stock at $3 and it all of a sudden just rips to say like $5. There's going to be halts in here. The market's going to trade up and then stop and then just go sideways for a set. And then all of a sudden something's going to happen. When the market opens up again, it can sometimes just jump up again and halt again, or it can jump down again and halt again. Because what happens is sometimes certain markets with news or market catalysts, these thresholds are hit. And normally what happens is you have a 5-minute window, After 5 minutes, the stock resumes trading, and it'll determine when you can start trading it. An SSR is a short sell restriction. When a stock moves more than 10% lower, all short selling is restricted until the market is triggered by an uptick in price due to limit orders. Okay, so you just want to be very careful knowing your environment. A lot of traders are not aware that this is a really serious business, and everybody gets excited about the money, but they don't realize there's little nuances that come into play here, and you just want to be calm and take your time and practice into a simulated account. That's why we always encourage traders trading in a simulated account first, getting comfortable before they ever move to live markets. Okay, and I don't want you to be scared of this stuff, because it's not about being scared. It's about being aware, right? Just knowing this. Okay, so let's talk a little bit about stock halts. We just talked about it. A stock halt is when the stock stops trading, just like this. And so circuit breaker halts are basically kind of like a halt, a stock halt. A circuit breaker halt is when the market stops trading, as well as a stock halt is when the stock stops trading, right? And this is normally when an indication it's extremely market volatility. Stocks can get halted. News can cause this. Earnings can cause this. Big catastrophic stuff can cause this. And a lot of times there's going to be codes, halt codes that'll be reduce on the platform. Sometimes you'll see this in your time and sales window. Sometimes you'll see this, on your level 2 window, and we'll talk about what time and sales is. We'll talk about what level 2 is. But the main thing here to understand is that you have codes, and these codes are going to basically dictate why the halt happened. Sometimes the T1 code is news. Sometimes a T12 is an SEC stock halt, like maybe they're investigating some type of securities insider trading or something. You never really know. Limit up or limit down, these are circuit breaker halts. These have to do with volatility, like we talked about. And the entire market, if the entire market trades more, like with the COVID pandemic or the flash crash or, Cyber Monday or anything like that, or Black Monday or whatever the case may be, the market can also have circuit breakers, right? And so it's just need to know the difference. One place you can go to find this information is the Nasdaq website. So the Nasdaq websites will give you the details, the price bands, and will tell you this. So you can easily just visit this website, nasdaqtrader.com/trader. I'll show you what that website looks like so you can understand where to go. And the reason this is important is it's just a Nasdaq halt list. It just tells you all the stocks that are halting. And it'll tell you their code here, limit up, limit down. And this happened today. So if you go and we take a look at some of these stocks, right, when they halted, if we look at RZ, what time did they halt? We just go RZLT. So at 9:50 this morning, RZLT. Let's just do this, RZLT. And you can see that this stock just halted. Boom, it just halted. So not sure why. I don't know what happened on it. It's just a stock that's not trading. Right? Very serious. You don't want to be caught into stocks like that. And not that we would ever trade that, but let's just go down here and talk about, AKER. Let's just see what that one is. AKER. Look at that. So AKER, this one doesn't look, let's take a look at where the halt happened. You can see this. AKER. That was a T3, T2. So Acre Biosciences. So if we look at a T3, T2, and we talk about what a T3, T2 is. A T3 or T2 is different codes. You can look at a limit up, limit down. This is a T12, right? So look at this. T12 is an SEC suspended trading. So if I look at WMGI, this is an SEC halt. WMGI, maybe I'm going to check that out. WMGI, Right Medical. Let's take a look at what that is. WMGI. Okay, and yeah, this was a halted stock. Right Medical. Right Medical. I don't even think it's here. Yeah, they pulled it. They delisted it. So you can't even see it anymore. So it's that's the thing. So the point of the matter is these are there to tell you that these are not stocks you want to be trading in because they're getting halted or the SEC's flagging them and stuff. And normally you're not going to have that happen on stocks that have any relevance. It depends on the code, right? And you know, they've got bans. They'll tell you when they resumped. You know, a lot of times you'll see that in your scanners on some platforms. You know, the big thing here is that sometimes if you're trading the small cap stocks, the stock will halt due to volatility, but that's not a bad problem. Sometimes that just means the stock's really in play, right? But there's a good and bad side of this, right? And so the good versus the bad, right? Circuit breaker halts can be our best friend as a day trader. They can be a good measure of how hot the market is. Many halts in one day is a sign of a hot market. Especially on stocks that are popping at like 50 to 100% moves in a day. It's also important to know your market and platform so you can understand how to deal with it, right? You don't want to just be like, okay, what's going on? And then I don't understand how to trade it. Just make sure you're familiar with the tools. And that's one of the reasons why we have training programs at the beginning set of our education courses, so that when you come into those videos and you come into the lessons, we can teach you the platforms, teach you the foundations so that you don't feel overwhelmed. So how do we know if a stock is halted? Right? Well, all equities platforms have their own way of showing this. You can check your platform or broker. This is definitely important. So if you're using NinjaTrader or TradeStation or TradingView or Interactive Brokers or Thinkorswim or any of these stock trading platforms, just check to see what they have for indications on halt indications, right? And it's good to know that. You can set up a scanner in some platforms to show you this, depending on the platform that you're using. And you know, this, you can also see this in the level 2. We'll talk about what level 2 is. Ultimately, level 2 will just stop moving. If the stock halts, you're not going to see level 2 moving. So the bid and the ask and the time and sales and stuff will just stop, right? And every 5 minutes, the stock will resume in 5-minute increments, 99% of the time, right? So a couple things here you want to understand is what's making a strong stock, right? Like what causes a stock to get halted? Why do we look at stocks, and why are we looking at these major movers, right? And realistically, it has a lot to do with both fundamental and technical catalysts. So one of the reasons why I love the stock market so much in comparison to, say, futures and forex is the stock market actually allows you to trade both on fundamental and technical information, where the futures and forex markets are mostly technical and volume based. So what's really nice about this is you get actually fear and greed, supply and demand actually driving the herd mentality. So you can even have a bearish market and have super strong stocks. I'll give you an example of this, okay? Today we had a bearish market. And the strongest market out of all the weakest, like you can see the weakest market was energy sector. So all of the energy stocks were the weakest. And then you can see the healthcare sector, the healthcare was the strongest of the bunch. Even though it was weak, it was stronger. So if I click on healthcare and I'm sorting through the healthcare stocks, take a look at this. Even in a bearish market, this was the strongest stock in the strongest sector. I don't know about you, but the market was going down today after the open of the mid part of the day. The market dropped, ended bearish. That don't look bearish to me. Why would that happen? Fundamentals plus technicals. That's the key. So you're not sitting there just worrying about, certain things that may or may not be apparent to you. There's a lot of other things that are going on in the stock market that, is an advantage. And we have scanners to find that, so you're not having to sit there and guess, which is a really big win for you because we've done all the heavy lifting. We'll teach you how to use the scanners. We'll teach you how to read the charts. We'll teach you how to do all that, okay? And the main thing here is we want to capitalize on that. We want to take advantage of those moves. We want to trade for base hits, but also trade for home runs if we can. We want to get on base first. Baseball is won by getting on the home first base. Most of the baseball games are won by getting on the first plate. Sometimes you get a big hitter hit up and it'll bring everybody back home, but a lot of times you got to steal second base, steal third base, right? Baseball is not won by grand slam hitters all the time, okay? And we want to make sure what a big move is, right? A home run is when a stock makes 20 to 30% or more in a day. Well, I'll give you an example of that. If I look at our gap scanners here, we got over 23 stocks in my scan list. Okay, so there's my gap scanner. And I've got over half of those stocks are up over 20% on the day. There's a reason for that. There's fundamentals in the news and we're trading technical patterns. So we're going to look at both fundamental and technical reasons for us to engage in stocks. And this is not just for day trading. This can be for sector scanning. This can be for large caps. This can be for looking at, just other aspects of earning stocks, right? We could be looking at different earnings and just understand that. So we're going to teach you these things in detail. It's just understanding why we're doing it, right? We want to find strong stocks. We want to find strong sectors. We want to locate the things that are really important to us and then trade that information, right? We want to basically have that to our advantage so that you're not just picking random stocks out of the blue. I want to talk a little bit about supply and demand, because this is technically what's actually moving the stock a lot more than we would think. Float is a very, very important topic you're going to hear us talk about. The float is understanding the supply of the shares available to trade. So when a stock goes public, it initials an IPO. It takes place, and there's a fixed number of shares in the open market that become available as the company's float. The float essentially equals the supply, which equals the number of shares available to trade. When a company has low float, that means there's limited supply. There's only a number of shares outstanding, okay? And so what happens is a lot of times you get news or you get these big drivers on these low float stocks, and they just rip like 50, 75, 100% gains on the day, and you could make a very, very, very good opportunity happen by trading low float, high moving stocks. And so this is why we look at this on a day trading basis. We want to have lower float stocks moving and grooving, and they move faster and they tend to have much bigger follow through on news. The key here, demand is typically a result of news or technical breakouts. So when we think about demand in the market, we're not just looking at price levels. We're technically looking at both fundamental reasons and technicals. We never just want to apply a technical pattern on a stock without having a reason for the fundamentals to drive it, because then you're just guessing. If you have fundamentals and technicals, you're ahead of the game 100%. So we have all of that mapped out in our platforms for you so that you can understand how to use that, okay? So let's talk a little bit about the difference between who's involved here so that moving forward, you understand why we do these things. Trading is institutional business, okay? And there's a difference between institutional traders and retail traders. Institutional traders are licensed by the SEC. They work for banks, hedge funds, pension funds. They based off money management. Maybe they manage family offices, right? And, some of them use high-frequency trading programs. Some of them use algorithms. A lot of them use computer servers. A lot of them are designing, automated systems that are trading very, very big markets like Google and Tesla and Apple. And so, and some of them are actually liquidity providers, right? Some of them are actually market makers creating a market so that we can actually buy and sell the market. Where retail traders are like you and me and everyone else around the world, we're market speculators. We're not licensed. You're actively engaged in trading your own accounts. Maybe you work for a proprietary trading firm, but you're still not licensed. There's many prop firms that don't require you to be licensed. Maybe you're managing family offices, but non-client money. Maybe you're trading your mom and dad's account, your grandparents' accounts, your sister's account, whatever the case may be, but you're not trading it as a client. So just know this, as a retail trader, we need to respect the fact that this is an institutional business, but what we're going to be doing moving forward so that you understand this is that we have strategies that are built for small cap gappers, sector scanning, correlation, large caps, earnings. We're going to scan for technical patterns on reversals, breakouts, hedge cross strategies for swing trading. We got hedging for your retirement accounts, and we got gap and fills. So we've got a whole bunch of different tools that are built so that you're not sitting there at a disadvantage to, say, professional traders. Tomorrow what'll happen is in the morning before the classrooms open or before we start trading, we're going to see all of these lists change. In fact, what will happen is this list will start populating pre-market at 4 o'clock in the morning. As soon as stocks start trading in the pre-market, it's going to hit our lists. As soon as the market opens, all of the stocks are going to hit this list. And sometimes there's 5. And see how they update automatically every couple minutes? They update every minute, every 30 seconds. The big thing here is you could have like maybe 7 stocks. Maybe you got 15 stocks. Maybe you got 3 stocks. whatever the case may be, our scanners are going to find them so that you're not having to go through 7,000 stocks to figure that out. Same thing here. Like, one of the things that I love about sector scanning, and we're going to talk about this, is that you don't have to be an institutional, professional, licensed trader to make a really good living in this industry. You just need to learn that there's certain things at play. Right now, if you want to trade strong stocks, you want to trade the stronger sectors. So we can scan the strong sectors. Look inside those sectors to find the best stocks. Look inside these sectors to find which ones were moving, right? Even though these markets, you know, they move up, right? Some stocks are really moving and grooving, right? They're moving to the upside while the market's dropping. So these are things that we're going to give you the tools and the resources, even for earnings. Let's say you want to swing trade earnings. We want to find stocks that have really strong earnings. So the reason this is important is we look at stocks that had earnings, and then we look for patterns to swing trade in your retirement accounts. So you may not always be day trading. You want to be swing trading. Definitely have advantages to this, right? So when you think about this industry and you say, well, I'm not a professional yet, I really don't know what's going on, or I'm trying to learn, we've done all the heavy lifting for you. It's about just making sure you go through the videos, you learn the basics, you learn the foundations, because a lot of the stuff that even we do in the stock market is transferable to futures and Forex and cryptocurrencies, because once you learn the market that you're trading, it's all about the patterns, it's all about the volume, it's all about everything that we do as a trader.
Welcome back, traders. Now, if you liked this video, make sure you check the links below, because there's all these other videos in the series that you definitely want to be watching to become a professional stock trader. Last but not least, hit that subscribe button, share the video with your friends, and ask a question and leave a comment below. We'll see you in the next video.